The debate between proof of work and proof of stake is one of the most technically and philosophically substantive disagreements in the blockchain industry. It is not simply a question of energy consumption or speed. It is a fundamental question about the source of a blockchain's security guarantees and the economic model that sustains those guarantees over time. Bitcoin's proof of work uses the physical world as its security anchor. To attack the Bitcoin network, an adversary must acquire more computational power than the entire honest network combined, which today represents hundreds of billions of dollars in specialized hardware and electricity infrastructure. This is a security model grounded in thermodynamics. You cannot fake the expenditure of energy, and energy expenditure creates an unforgeable cost for any would-be attacker. Ethereum's proof of stake uses capital as its security anchor. Validators must stake ETH as collateral, which is subject to slashing if they behave dishonestly. To attack the network, an adversary must acquire a majority of the staked ETH, which at current prices represents tens of billions of dollars. The security model is grounded in economics rather than physics, with distinct trade-offs that institutions evaluating either asset must understand. From a pure attack cost perspective, both Bitcoin and Ethereum present extraordinarily expensive targets at their current market capitalizations. A successful 51% attack on Bitcoin requires sustained acquisition and operation of more than half the network hash rate, an investment in specialized ASIC hardware measured in billions, followed by ongoing electricity costs measured in millions per day. The attack cannot be sustained indefinitely, and the economic cost of the attack to the attacker typically exceeds the economic gain from even the most aggressive double spend scenario. Ethereum's security model has a different vulnerability profile. An attacker who acquires 33% of staked ETH can disrupt finality. An attacker with 51% can attempt censorship attacks. An attacker with 66% can attempt to finalize conflicting forks. But critically, any such attacker puts their stake capital at risk of slashing. The protocol is designed to detect and punish provably malicious behavior with permanent capital destruction. This creates an economic deterrent that is different from but arguably as robust as Bitcoin's energy-based deterrent. The key institutional distinction is in the nature of the security assumption. Bitcoin security can be modeled purely in physical terms: hardware costs, energy prices, and thermodynamic constraints that are independent of any token price. Ethereum security is partially circular. It depends on ETH retaining sufficient value to make the cost of acquiring the required staked ETH prohibitive. This creates a theoretical vulnerability where a collapse in ETH price could reduce attack costs proportionally. The long-range attack is perhaps the most intellectually interesting security distinction between the two models. In a proof-of-stake system, an entity that once controlled a majority of stake could theoretically rewrite blockchain history from that point forward, using old private keys to create an alternative chain. This attack is not possible in proof-of-work because the attacker would need the current hash rate of the network to rewrite recent history, not historical hash rate. Ethereum and other major POS protocols mitigate long-range attacks through social consensus checkpointing. Clients periodically commit to a specific chain history that becomes immutable from the client perspective, regardless of what alternative chains might be constructed. This is an effective mitigation but does rely on the social layer of the network rather than pure cryptographic guarantees. For institutional investors, the practical security distinction is that Bitcoin's security model has been battle-tested for 15 years against sophisticated adversaries including state-level actors, and no successful 51% attack has ever occurred at meaningful scale. Ethereum's proof of stake is newer, and while the theoretical security model is sound, its adversarial robustness across multiple market cycles and geopolitical scenarios has not been fully stress-tested. This is a legitimate differentiation factor in institutional security assessments, not a fatal flaw. Bitcoin's energy consumption is simultaneously its most criticized feature and one of its most important security properties. The energy expenditure is not a bug to be optimized away. It is the fundamental mechanism by which Bitcoin converts real-world resources into cryptographic security. Every terawatt-hour of electricity consumed by Bitcoin miners represents an equivalent barrier to attacking the network. The context provided by comparative energy benchmarks is important for institutional discussions, particularly with ESG-focused boards and investment committees. Bitcoin's energy consumption is comparable to the global banking system and lower than the gold mining industry, both of which serve monetary functions that Bitcoin explicitly competes with. The argument that Bitcoin's energy consumption is uniquely wasteful relative to its monetary utility is a values judgment, not an objective fact. Ethereum's proof of stake represents a genuine breakthrough in energy efficiency, a 99.95% reduction in energy consumption while maintaining a multi-trillion-dollar secured network. This dramatically changes the ESG calculus for institutional investors with sustainability mandates. For Ethereum, the energy consumption debate is largely resolved in favor of the asset. For Bitcoin, it remains an ongoing consideration that institutional communications must address proactively. The history of the POW versus POS debate spans the entire history of the blockchain industry. Bitcoin's proof of work was the original design by necessity. In 2009, there was no large pool of existing cryptocurrency holders who could stake as validators. Proof of work provided a mechanism for bootstrapping consensus from scratch, with no pre-mine and no trusted founding parties. Ethereum chose proof of stake as its long-term consensus model from its earliest technical roadmap, driven by both environmental concerns and the theoretical efficiency advantages of a capital-based rather than energy-based security model. The 7-year journey from the original Casper proposal to the completed merge in 2022 reflects the genuine technical difficulty of transitioning a live, multi-billion-dollar network from one consensus mechanism to another without disruption. The institutional verdict as of 2026 is effectively a coexistence. Bitcoin retains its position as the premier digital store of value, with its POW security model valued specifically for its long track record and physics-grounded security guarantees. Ethereum's POS model attracts institutional capital seeking yield-generating smart contract platform exposure with a more favorable ESG profile. Both theses are legitimate, serving different institutional mandates and portfolio construction objectives. Both consensus models face long-term security challenges that are worthy of institutional monitoring, even if they are not imminent threats. For Bitcoin, the transition from subsidy-funded to fee-funded security is the most important structural question facing the network over the next decade. If Bitcoin's block space does not generate sufficient fee demand to compensate miners as the subsidy falls, the economic incentive for miners to secure the network weakens progressively. For Ethereum, the increasing concentration of staked ETH through liquid staking protocols is the most actively discussed governance and security risk. When a single protocol controls more than 30% of staked ETH, the theoretical attack cost for a coordinated governance attack on that protocol falls within the range of well-capitalized state-level adversaries. The Ethereum developer community is actively designing mechanisms to limit liquid staking concentration, but no solution has been deployed at scale. Quantum computing represents a longer horizon risk that is currently more theoretical than practical. Current quantum computers are nowhere near the scale required to break 256-bit elliptic curve cryptography. Both the Bitcoin and Ethereum communities have quantum-resistant cryptography research programs underway, and a future protocol upgrade to post-quantum cryptographic standards is considered feasible well before quantum computers reach the required capability threshold. The POW versus POS debate will continue for as long as both Bitcoin and Ethereum exist as major networks, and institutions should not expect it to be resolved decisively in either direction. Both consensus models provide robust security at current network scales. Both have theoretical attack vectors that require active monitoring, and both will need to adapt to long-term challenges including declining subsidies, stake centralization, and eventually quantum computing. The investment implication is that consensus mechanism choice should be one factor among many in institutional cryptocurrency evaluation, weighted according to the institution's specific security requirements and ESG constraints. For ESG-sensitive mandates, Ethereum's POS energy profile is a genuine advantage. For mandates prioritizing long track records and physics-grounded security guarantees, Bitcoin's POW has an edge. Most sophisticated institutional investors treat the two assets as complementary rather than competitive. Bitcoin as the store of value and monetary asset with POW security, Ethereum as the programmable platform and yield-bearing asset with POS economics. This portfolio construction approach is not a fence-sitting compromise but a recognition that the two assets serve different roles and their consensus mechanisms are optimized for those different roles.